Hi, this is CF Lieu from REIT Method. If this is your first time here, you might want to know me a little bit. What I do is that I've co-founded a course, an online course called REIT Method, which teaches people about REIT investing. Now, REIT is actually an asset class whereby it's a bit like, no, it's not a bit, it's a lot like property investing, but instead of buying a property, you actually bought a fund, then that fund actually very focused on only investing in commercial property. And over the years, due to the slowdown of residential property and in the residential property market, of course, you can use this fancy tactic strategy teach by all gurus to actually make money, which still works, but not as well as since like in 2013, all that where a lot of people make big money. For as the time of this, as time goes by, there's a lot of decentral bank that clamping down on all these strategies and all that. So for a lot of people, they are actually stuck when they have a property portfolio that does not generate a lot of enough rental income. So what we help people that have this problem, a problematic property portfolio, whether financially or whether you are getting to a point where you do not want to you don't want to manage tenants anymore. That is why they say that what is next? What is the thing that can replace my property portfolio? Doesn't go away from investing in property, but you invest in a property in a more sustainable manner, very dividend cash flow, cash flow focus. That is where REIT method, my REIT investing course, will be able to help you to achieve that. Even though you don't need to manage tenants, you don't need to worry about bank financing, you don't need to be taking leverage and all that. So if you really want how this could help you, check out on the below, the one that is what we call a REIT method. You just go there and go to that page and sign up for a free upcoming webinar on what I'm talking about, REIT investing. But just in this video, right, this is supposed to be a module that is inside the REIT course that I'm going to put in. But for the benefit of you, I'm going to just also take this lesson and just put it out, and so hopefully you will also gain benefit from this lesson if you are not already a REIT method member. If you are already a REIT method member, you know that inside the course there's a lot more things that I cover for you, so don't worry about that. This is just part of the thing that I'm putting out there. You know that inside, if you are a REIT method member, there's a lot more thing about the potential of REIT around the world, in Singapore and all that I'm covering for you that is not available anywhere else, not even on my channel. But in this lesson, right, if you are a veteran investor, I think you will find this very useful. If you are a very analytical investor, you will also find this very useful, because we are going to dissect AXIS REIT. We are using the 2018 report, and what I'm going to do is that I'm going to jump to the sections where I think it's important for you to know what are the things to look for when you look for good REIT or real estate investment trust to invest into. Not to say there are no good REITs out there, but I'm just saying taking AXIS REIT as an example, because it's one of the oldest real estate investment trusts in Malaysia. It has a certain quite a high profile branding and all that. So I'm just going to use this annual report as an example, because basically it's a very good annual report. It covers a lot of things comprehensively. Although AXIS REIT is focused on industrial property, you can leverage the same for other type of REITs annual report and all that. So let's get right into it. So the first thing I want to actually, normally a good annual report, they will have so-called at a glance to say what's the market cap, what's the total asset of the property under a REIT, what are the total space under management and all that. So this is what I highlighted. It recorded a net income after tax of 25% increase. That is huge, right? That is huge. where DPU, dividend per unit, increase 6%. Now that is just imagine your rental income increase 6% every year. Not only the rental yield, but your rental income increase 6% every year. So for a lot of people who are invested in residential property, you know that to get that kind of increase is very hard, because it's either you cannot afford to increase your rental because your tenant will move away, but or when you increase, you must have, you know, your property must be in a hot area where people are actually queuing up to rent your property, which is very rare in this scenario. And a few things to know is that, you know, that just on the very first page you can see that they highlighted already what is the DPU, distribution per unit, for 2018, which is, as you know, dividend per share. It's the same thing, but for a REIT, because it's a fund, the structure is like a unit trust fund. It's not a unit trust fund, it's still a public listed stock in Bursa or in any stock market. They just put it as DPU. So moving on, just this one you can actually read on your own, but I just want to jump to this section which I already noted over here. Jump to page 26. This is where this entire annual report, you know that it could run into 100 and 100 on pages, and for this point, for this report, it's 300 over pages, which you do not need to go to read each and every word, right? Just read what is important, which I already highlighted to you for this. So you know that authorized investment, they invest, the REIT only invest must be in real estate, brick and mortar real estate, and that generates a recurrent rental income. So they are REIT are not property developer, as you know. So initial public offering price is 0.625, equivalent to 1.25 per unit prior to unit split. So for some of you already who are looking at AXIS REIT, and you see that the price actually for I don't know which year is it, I don't remember, and it actually dropped by half. That is not a price drop, that is actually a unit split. So unit split meaning that they have twice as much units or shares in the market, but the price has been half. And it is not a price drop, but an adjustment, a unit split, right? So the distribution, quarterly distribution, first quarter to third quarter, 95% of current year-to-date DPU income, and at least 99% of the fourth quarter, they distribute at least 99% of the current financial year rental income, net rental income back to investor, which is really, really commendable, right? So this is what you can compare that as, you know, your normal dividend payout ratio for company. They always say like private bank pay out like 70% of their income and all that. For a REIT, this actually means the same, but normally for a REIT, they are obligated, as you know, to pay out 90% or more of their rental income, net rental. So say 30, let me just scroll over here. A few positive things. A very good REIT, if they have these few things, they will always highlight that in the management report. They say their property value at 2.8 with accumulated net lettable area of blah blah blah, and then they say occupancy rate 94, because real estate really is of no use without it being tenanted, and without tenanted and receiving an income, rental income, right? So overall, they say for the financial year they achieve a 5% rental reversion, which means that 5% there is a rental hike, a rental increase after the like a tenancy agreement actually expire. Then you either retain your tenant with a higher rental, or you get a new tenant with a higher rental. So you look at here, 25%, 6%, so up DPU up 6%, net property income, as you see, 25%. This one I wouldn't take it as just a pinch of salt, because this distribution yield depend on what are the price you are entering. In this sense, they are just taking the price DPU divided by the price on the 31st December, which is the end of the last trading day of the financial year. So they also have something called the dividend reinvestment plan, which I'm going to go through later. Dividend investment plan, which means that new units are being issued out, okay? Amounting to sukuk. So AXIS REIT, because it's a Sharia compliant, they use sukuk as a financing, okay? So and what else over here? 85 million mature fully redeemed using. So what it means, like sukuk is like a bond you issue like for a fixed number of years. After a certain number of years, you have to actually have to repay the bonds, and then over this 5 years actually paying the interest to your bond investor, okay? So this is what it means, which we're going to explain more when we go through the report. So refinancing short-term credit facility, debt maturity, okay, we're going to go through that, but this is just some highlights. this is what they highlight about. It's first listed on 2005, and it used to be only like 5.64 of dividend per share, right? And this is what we call a star here. Like I say, there is a unit split. So unit split, it also happens in the sense that it used to distribute a dividend of, before the unit split, right? Before the unit split, it has like, I think about 18 to 19 cents per unit. So after it split, then you know that the dividend per share it also split. Doesn't mean the dividend per share actually half, but because there's more number of units, so you divide that by the increased number of units. So on a per unit basis, your DPU or dividend per share or distribution per unit will actually go down. Okay, so it's 31st and then 32. Now this is very interesting because it says that it's asset acquisition completed in 2018. Now what it means is in the financial 2018, which is from January to December, they only completed, meaning February, June, August, December, which means that whatever rental income that you are seeing in the income statement in the annual report, right? And you know, it already recorded an increased DPU, but the potential is still not reflected fully yet, because this property, when it completed in June, it only managed this property to contribute half of the what it's supposed to contribute in terms of the annual rental to the REIT itself, right? Especially for this August one and the one for the December. I mean, it just reflected like only in 1 month, so it is not reflective of the entire rental income yet, which I'm not surprised in the coming year. When this property, let's say, come in financial year 2019, this is where this property can really generate its rental income for the full entire 12 months, right? That is where you really can see, you know, possibility or potential of an increased dividend. Okay, and they also slip you in with a little bit of a trailer over here, what we call as a portfolio outlook, right? You always want to look at the manager report. If there's one thing that I've learned to say, that you do not have time and you cannot really understand what are the back end of the report, where there's this accounting, income statement, all that, skip that, but always look at the manager report, because they always try to make it in a very layman term, and they always let a bit of, not let the cat out of the bag, but for a lot of real estate investment trusts, right, they would not say what property they are actually already have their eyes on, but the real estate investment trust or REIT, they will always give you a hint of what they are doing. Like this is they say that AXIS REIT, they already want to acquire another industrial property in Bayan Lepas in Penang for a consideration of 20 million, which is around like mid-size or small size. It's underway, expected to complete in financial year end. Again, one more property come in, but they have not really finalized it. That's why they're not mentioning name. They don't want to actually tell you the name first. But you can see that if they have a pipeline of a new acquisition, that is where your rental income will not be reflected in the immediate financial year yet, like I say, but in 2 or 3 years, that is where you really have a very good picture of with the potential and all that. Okay, so geographical wise here, and this is director profile, which normally I would skip, and I would go to 53, right? 53 manager report over here. So here you can see there's a fair value gain of investment property, which is 40%. So meaning that it's the portfolio actually gained 42 million. Hold on, fair value gain on investment property. So no, the portfolio gain, for the gain itself in terms of the capital gain of property, which they are not selling yet, but every year they will have to re-evaluate their property, right? So what happened is the gain, this capital gain was 42 million compared to the previous year, the year before, which is 30 million. So again, every metric here is some of KPI, which is good. They say that there's an increase, right? 5%, how many percent? Glance that over. Again, further detail in case you are a first timer and you did not follow AXIS REIT for whatever reason, because you're not investor or whatnot. Now this is also the place whereby you want to pay attention to before you invest. Newly acquired AXIS Aerotech Center. It's a second build to suit development, meaning that AXIS REIT is one of the more advanced REIT, where they not only buy completed property, but they actually have a certain existing tenant profile that have a certain requirement, and then that's why they enter into a agreement with them, the approval for security commission, because by a real estate investment trust or REIT, normally they cannot develop property because they are not property developer. Their main business is to buy and hold rental generating property. But if they already have a tenant and sign, a tenant have a certain design or infrastructure that is not available anything else, AXIS REIT will come in to say, I'm going to buy this for you and build this for you, and for that we're going to sign a 20 years lease agreement or whatnot. And that is where, I mean, that is good, right? That is good. It is a bit unorthodox, but for AXIS REIT, this is actually a good way they have. It means that they really work very closely together with their tenant to so-called build to suit because comments on 16 December this one following the acquisition, the fair value gain, expect to derive 5% rental revenue and all that. So that is actually a very commendable thing, because they are listening to the existing tenant, normally existing tenant or could be a new tenant, whereby the risk, if you don't want to just build and hope and then you secure your tenant, because that's a bit hard. But in this case, they're actually saying that, look, they ask the tenant what is that they want, what is the kind of property they want. So that is why they are building that specifically for that tenant. For them to mitigate the risk, they always want to sign a long lease, maybe a 10 years, 15 years tenancy with the tenant. So, the risk is mitigated. If not, you sign just 2 years and then the tenant say after 2 years, I don't need this property anymore. And then because this property is specially custom tailored for this tenant, then they are going to scrap whatever that is custom tailored for this tenant, and then for another tenant that is extra cost. So if you get what I mean, right? If you don't, comments below and we'll expand that more. So this is essentially very, very, very good. And we're going to scroll through another thing is iDrip. iDrip is actually again very special to AXIS REIT or maybe some REIT not in Malaysia, whereby normally because REIT they distribute to you dividend is in terms of direct to your bank account like your normal shares, right? However, when for AXIS, I think on the third, not every dividend distribution, because they distribute dividend every quarter. I think on the third quarter they give you a chance to actually reinvest back, but at a discounted price. Just put it that way, right? They have a way to calculate to say discounted price. You can, instead of this money going to a bank account, you just fill some form and then you're going to reinvest that, buy more units of AXIS REIT, new units of the AXIS REIT at 7. Let's say in this case they are talking about a 7% discount over here, right? To the volume. So it also means that there will be a bit of more units in the market. Now some people might be very concerned about dilution. Now if you're not sure what dilution is, comments below. But I've calculated this over so-called the number of units, normally less than 1% of the total market cap, total outstanding unit, total units in the market. So I would say the effect is very minimal. But and this investment dividend reinvestment plan is normally the capital raise. It's like you are doing a mini IPO. So for this AXIS Real Estate Investment Trust or REITs, they're actually taking this money, let's say in this sense 6.8 million of capital, okay, because this is fresh money, right, by issuing new shares. Right now you have to understand that the existing shares that you buy from the market, that is already what we call the secondary unit, which means that you are actually buying, you are actually forking out money to buy the AXIS REIT share, but you are actually buying that from another person. So whether gain or loss, it is what enjoyed by you and the other person. So this money actually, extra money doesn't really flow to AXIS REIT, okay, or any public listed company as their capital. But if you are actually buying that direct through investment dividend reinvestment plan or DRIP, so that is where the money actually goes toward the company. In this sense, it's the REIT manager or the REIT stocks, whereby they can use this money. Again, it's not a big money, relatively 6.8 million, whereby they use it towards a lot of the asset enhancement initiative. Okay, Now moving on to 56 over here, and I want to explain a bit on acquisition of Lieu accretive property. So fully debt funded, so they acquire 5 property. This acquisition fully debt funded. Okay, debt funded meaning that they didn't issue you new units. They are just borrow more money from the bank using their property portfolio, existing property. Some of them charged to the bank. That's why they're gearing. You see there's an increase on the gearing. Also they are also paying this what we call a deferred payment structure for acquisition. So they acquire some property facility in Kuantan, it seems 2 years ago, but then only this year they are probably paying the last tranche of this based on this sales and purchase agreement. Okay, so acquisition you acquire property debt funded, they borrow money. And unit in circulation, as you can see, this is the unit in circulation. Why from here to here? Like you say, like I've explained to you, if normally if they do a right issue and whatnot, the unit in circulation, if it increase by twice, normally if you do not subscribe and whatnot, your existing shareholder will be diluted in terms of the dividend holdings and in terms of the price, right? If you don't subscribe. But in this case, it's not, because it's just a unit split which they have explained over here, adjusted to reflect the this is like it's split into one unit split into 2 units. That's what it's about. And probably operating expenses. Now this is very interesting over here because I'm looking at 2018. Yes, that's true. But what happened here is that very interesting. You know, gross revenue actually increased, but you know, in here to here, actually property operating expense actually decreased. Now this is a very good trend, because you can increase your revenue, but still your expenses are keep under check. Now even if you look at 2018, it's not the real estate investment trust or REIT actually doesn't have a so-called major increase in property expense, right? It's still manageable. So I would say that the REIT manager actually does a good job in controlling the property expense as well. So let's move on. So moving on, the fund will be named a full year income. Like this is what I already mentioned, right? Because some of this property, especially most of the property are acquired in June-August period in 2018. And in December also. So the full potential of the rental income has not been captured in this annual report yet, or for the full year of 2018. So therefore, from 2019 onward, the fund will be from full year distribution from property acquisition that were completed in 2018, which is the dividend could be still even higher than 8.74 going forward. Okay, so again, I'm just showing you, giving you a perspective which is not usually people can relate, because you have to take a few pieces together and pound and actually combine it together to actually know the full picture. 58, okay, this one actually for general net yield. Okay, now this is also very important. This doesn't really directly affect you, it's indirectly affect you, because if the properties actually have the property yield of this AXIS REIT is actually good, I mean it's actually strong, meaning that it's likely they can command a higher rental. Okay, so they already show you the net yield was 8.2%. So gross yield, of course, not yet deduct all the expense, but net yield already deduct all the expense. So property yield, as I've shown in the con, is the earning power of a specific REIT. So we just go on again. This is page 58. 59, I've highlighted something over here. Revenue rose, positive 5% rental reversion, increase from rental. This include 10 years fixed lease with Nestle. Like I say, they probably, I think they build this, if I'm not mistaken, custom build from Nestle. AXIS Mega Distribution Center with 20 years, 10 years fixed lease. Okay, and 20 years, and the 20 years fixed lease, you okay, this Nestle 10 years, this is on 20 years. Yeah, the Subang one is 20 years, commence on 1 June. 1st June, you know, this is yet the revenue yet to to have a full financial year for it to show its potential. So I'll expect, mark my words, I expect the dividend yield is going to really jump quite steep. I mean, it's a good thing, right? It's go up quite. So they also highlight the higher the revenue, which outpaces the increase in property expenses, which is good. So the increase in revenue in rental income is actually faster than increase in property expenses, resulted in, again, they want to repeat that because it's a positive thing, 25% or year-on-year increase on the net property income NPI, as I've shown out in the course, right? So this one, 59. Now, if you really cannot follow what is going on over here, If you're already a member, it's good. If you are not you haven't gone through the course and you're not even a member yet, so click on below reitmethod.com to join for upcoming webinar where I can share with you more on how to, on the basic first, because this lesson is for sure it's not a basic lesson. Okay, I have to be very frank with you on that. Okay, so moving on, this is page 59 and I want to go to page 60. Okay, this is page 60 and it shows all the profit over here, profit income. So a REIT, this one is also something that in case, because even if you are a member, maybe you have a bit confused sometimes, because when we look at the income statement, I always only want to look at how good is the property generated income, which is why I do not really take this income generated from investment. Investment means that if they put a certain cash inside fixed deposit, now that is generating income also, right? But that is not income from operating. That's not rental income. That's not income or profit from operating their core business, because I want to only consider whatever their core business is and how much income they generate over here to any company, not only for real estate investment trust, not only for it, to really know what they are, whether their core business is doing good or not. But this income, which is not from the core business, just for putting some money in the bank, they're generating this income. So this is what it means, right? Even that, I mean, for a company, actually 700 over 1,000 is not so much of, it's not a big amount, right? But still, it's a big amount for retail investors. So I just want to highlight it to let you know that this is what it means by profit from investment income, that item in the so-called profit and loss statement, or they call it comprehensive income statement. Moving on, for AXIS REIT, also they say the total investment property of 200.8 billion also include capital expenditure of 74 million, including development costs and all that, which has been capitalized. So when they develop this, there's certain cost to it also, right? So beside the property value, this cost is also capitalized. It's a capital expense which has been considered as part of the property value for AXIS REIT at this point of time. Now you can see this in another loss or gain over here. Most of the property here gain, some are valuation loss, so you can see why there's this fair value gain over here. Moving on to page 62, moving on to page 65, which is interesting because is that it? Oh yeah. So non-property expenses, as property investment as well, it is not 100% smooth selling. You can just mitigate the risk. Maybe like 5% or 10% of your rental income will be, you cannot, maybe the tenant have some problem, they're going to run away and all that. So AXIS REIT has, at the point of this recording, they have 45 tenants. Now imagine you have 45 tenants. Some of them they are not going to go like 100% good all the time, right? So this is why you see that non-property expenses included bad debts written off or impairment or reversal of losses on trade receivable. Trade receivable meaning that the rental has accrued but they are not yet received. So sometimes they assume it's already going to be received, but something happened, maybe there's devaluation or whatnot, tenant go bankrupt and all that. So this is what it usually means. Again, it could mean a lot more things, but just for the sake of this, making layman for you, so you can understand. Now the other thing is alignment between the manager and the fund. So the REIT manager has approval from unit holder. The manager is paid in fees, the management fee, not in ringgit and cent, but in fees. So there's alignment interest. Again, in the course I cover this in detail, why how they want to structure the fees and all that, so that there's alignment interest between the investor, minority investor, and the REIT manager. So moving on to this one, effective profit rate. Now financial profile is very interesting also, because this is the important thing. What I've taught in the previous modules, if you are in the course, in the REIT method course, is they when they borrow money, there's a certain interest rate, of course, also, right? It's what we borrow money, but obviously for AXIS REIT, they are able to have their financing at a relatively lower rate, 4.3, 4.2, compared to normal like 4.6 and whatnot. So if you look at this and it goes like sky high, this is why if we go 5.0, you know that the REIT manager is not doing everything well to secure a lower interest financing, because this interest rate, meaning that they have to pay the interest. The interest is expense, which will reduce the dividend being distributed to us. So of course, the lower the rate is, the lower the financing expense or the interest expense, and then that will translate into a higher dividend per share or DPU, right? 65, and then we jump to 71. What's then 71? Why did I what 71? Okay, 71. All right. As a result, then a low impairment loss on trade receivable as a percentage of total income. So 4.6 million impairment loss on trade receivable amount 215. Trade receivables stood about 200, so 0.1. So that's fine, right? I mean, there are certain things that, you know, your rental income have problem to actually collect from tenant. This is very normal, I think, happen in any business, so there's nothing really too much to concern about, right? So you know that even this is actually REIT is actually having some issues when it comes to not big issues, but it's a part it's a bread and butter, not bread and butter, it's part and parcel of running a business or property manager, you know, collecting rental income and all that, right? It's just in a day's work, right? So moving on to 79. What else is moving on to 79? You've seen the long-term lease have a pre-negotiated rental step up. So they are, so when they sign a long-term lease, what happened is that they have like 5.5 and all that. So step up, like first 5 years this rental, then the next 5 years this rental. So they already have that built into the tenancy agreement, right? Instead of after 5 years they have to beg the tenant to say, hey, come on, I want to increase the rate now. That does not happen in residential property investment. For for real estate investment trust or REIT, this is actually very good if you are the shareholders, right? You are the investor. So moving on to 81. Okay, hold on. Is there anything here? No. Diverse tenant base. Okay, you can see office and all that. Move on to perhaps 82. What is it? Maintenance costs. Okay, this is also very important. Sometimes different REIT, their maintenance costs are borne by the tenant, sometimes borne by the REIT or the property. Now for retail mall, you know that it's borne by the retail mall. That's why the retail mall property expenses are relatively high. But for industrial REIT, it's actually relatively low because the maintenance costs are borne by the tenant, right? Managed by the tenant, the security service and all that. So tenants of multi-tenant generally have 3 of multi-tenant. That's meaning that they are large tenant, their biggest customer like Nestle and all that. They will sign like 20 years, 10 years of lease, or 5 + 5, all that. But for some of the property with smaller tenant, right, multi-tenanted property, they have normally a shorter term lease, especially for office, which is what we call a 3-year term lease, which are renewed at the end of each lease term at the prevailing rate, providing opportunity for positive rental reversion upon renewal, right? So this is it. 82. What else? Okay, we jump to maybe 98. Okay, jump to this. Now if you want to look at this, you can. You say what a major tenant. For me, I just skip through. I think this is by it means it's, I would just want to show you this is what we mean by this renovation to actually increase the property value. Doesn't really directly affect the rental income, but this is what they are using when I say that they raised the income from a dividend reinvestment plan, right? For which I mentioned earlier, about 6.8 million. They're going to use that for, you know, do all this, right? Because this is actually doesn't cost much, and when a building is sold, you have to refurbish it, and that's part and parcel, and then it's all in a day's work. So put on to here and just skip to here. I think this one is a compliant facilities, which is you can go through yourself, but I'm going to skip to, hold on, page 146. I think 146. What is this? Okay, manager discussion. So I'm going to skip to that now. This portion, I think this is not as I mean, of course you can read, but this is about how they manage their investor relation and all that. Not directly something that is too important for us to actually calculate our return, which is why I'm going to fast forward to this. And this marketing report also, now this very interesting because they say how they're going to engage their stakeholders like employee tenants or even real estate agent and prospect. They even do cold calls, which is I'm not sure whether cold call work as well, but they just put it in, which is pretty interesting, pretty funny, right? Pretty funny. This rebranding not so important, but 146, what else? Okay, 219, maybe we're just going to jump at. Now this portion is actually something, the annual report for Real Estate Investment Trust in Malaysia, or REIT, right? It used to be a bit shorter, maybe just 200 pages, but now it ballooned up to, for example, it's 300 pages because they have what we call the sustainability report, like how they manage the staff, environment, all that, which normally I actually skip this and I'll skip it to some of the important parts inside the financial statement, which I've marked as 219. Okay, page 219. What I have over here, like manager fee, right? Manager fee, now that a REIT manager, like a property manager, they charge a fee based on the total asset under management, total property asset. For example, AXIS REIT, they charge up to 1% per annum. So actually when they will acquire new property, actually it also benefits them. Not to their benefit, but actually there's an interest alignment, right? They get paid more for acquire new property. The property has to have a good yield or yield return. So they get paid more, and investor also receive more dividend. So that is the interest alignment, right? And it's pretty standard, 1%. Some REITs are charged lower, but I think 1% is pretty standard. The managers are entitled to receive acquisition fee of 1% of the acquisition fee or disposal of 1% or 0.5, meaning that if they sell a property, it's 0.5% is their fee for selling that property, right? If they acquire new property, that process of acquiring also 1.0. Now, here's the thing. If they do not, actually it's foolish. Some people say that, okay, they want to buy and sell just because they want to earn this. No, actually it's foolish to assume that, because if you sell a property, you just earn 0.5. Because you sell the property, your property portfolio will going down, right? So your base fee, meaning that it's lower because your property portfolio will go down the value, right? When you sell a property. When you acquire a property, it's good because your receive a base fee go up 1% out of an enlarged property portfolio. Also, that transaction of buying, also the REIT manager get paid 1%, which is fair. I think which is fair, right? I mean, more like the industry standard, right? So note number 4. Okay, now moving on to let me see, 251. Okay, 251. I'm going to just skip this. Now this financial statement, of course, like what I say, this is something you can read, right? Net asset value and statement, profit and loss of comprehensive income, financial position, which is your investment property, which is over here. All right, so you can read this, but I find that you can read this. Okay, if you're an accountant, maybe you read this, you prefer to read this, but I find it more useful to actually read in the front, whereby they tabulate everything for you nicely, rather than read this statement. But some of the information over here are important, which is why I'm covering this section for you. So we stick to 251. Just skip over here, and you see the deferred tax liability as I've covered in the course. When they sell a property, and real property gain tax is still applicable, right? However, more than 4 years, non-citizen has been changed from 0.5%. So as you know, the budget 2019 has been changed. Previously it used to be, and what I call is after 5 years hold this property, sell this property, you are not imposed real property gain tax, but now it is. So that is why when they actually sell the property, there will be property gain tax. So in business model, they are not expected to have for less than 5 years. Okay, so they are not expected to have impacted by this. Financial being the deferred debt on the accumulated level that are expected to be realized to sell. So this one is disclosed to finance being a deferred for average exposure on accumulated fair value gain. Remember that are expected to realize to a sale. So, but this has not happened. That's why I say defer. So 251 let's look at 254 over here. I have something for you now. In case you're wondering what are the type of property expenses that's incurred under real estate investment trust or REIT, so in this AXIS REIT example, you can see assessment. You know, it's like what you are being very familiar with: assessment fee, property management fee, utility, and all that. So these are all related expenses. Okay, and it is, you know, when they have more property, this is going to go up. The ability for them to control these property expenses from skyrocketing is the factor to determine that we will get our dividend increasing every year. Because if the property expenses actually outpace the growth of revenue or rental income, that is where our dividend per share or DPU will actually stay stagnant. So that's, again, a REIT manager role plays very important thing. Now, tax expenses, current year debt, deferred tax expense. So nope. Okay, this is no effect. And I have again for you 277. Where is 277? 277. All right, 277. Okay, so here this is 277 unit holder statistic. Now, very again this is again as a wrap up before we call this we call it a day. Unit holder statistic, you can see that over here, what are the largest shareholder of this REIT? You can see that it's not Citigroup, but Citigroup nominee tempatan, because they are holding this on behalf of Employee Provident Fund. Now you say that why EPF rather than holding it direct, why they want Citigroup to hold it, the nominees, right? It's because nominees actually can, on behalf, like they act as a proxy, or they represent the real beneficiary, the investor, to do all the paperwork. For example, they have this investment distribution plan, dividend reinvestment plan, or any paperwork like right issue, private placement. Actually, Citigroup can do all this for their for whoever they're representing, which is good, right? So they don't have to do a lot of paperwork. Okay, so for high net worth investor and for institution, normally they also do that, right? But you know that the shareholder over here, and when you see shareholders, the top 10 shareholders are always EPF and Amanah Saham and all that. You know that this is how stable this REIT is, because this guy are actually easily getting the REIT dividend to pay us the dividend for ASB and also EPF. So easy peasy for them. They already cover very easy for them to get dividend. And when you say big guys investing in the REIT, you know that that cannot be a bad REIT. Okay, again, I am generalizing over here. Of course, you have to look at other things as well, but because that's why I teach you, even though you don't look at it, you need to evaluate on your own. But when this is just a supporting fact that this REIT is held by big institution, which means that it is something which is still a good REIT to hold on. It's not institution would not actually continue to hold that. So 277 page, and we are getting to the end. And 282 over here. 282. Okay, this is interesting. Can manager vote at unitholder meeting of this REIT? No. So this is applicable for all. So this is very transparent, because they are manager not able to vote unless normal shares where you are a major shareholder, you can still vote, right? So this one is something more detail about what are for REIT. AXIS REIT is share compliant. What are the non-permissible activities? So their property cannot have this kind of activity. If yes, then this must be below a certain percentage also. So what else? 286. I highlighted this. So this is just authority to say that REIT, this AXIS REIT, they also sometimes they will do private placement, but the private placements cannot be more than 20%, meaning that they are raising, they're issuing new units, but you cannot retail investor mostly cannot participate into it. Only the big guys like EPF and all that, but they cannot issue more than 20% more of the total units out there in the market. So this is called private placement. Now, because the private placement is not something they can execute right off the bat, they need shareholder approval. So if minority shareholder normally have to vote, right, to say that whether they still, it's like an authority. So it was renewable every year, meaning that in the previous shareholder meeting, they have authorized that anytime when AXIS REIT manager see a good opportunity, they can actually execute private placement without organizing another meeting just to ask for shareholder permission. So it's like they are getting a blanket approval from all the shareholders. But this blanket approval is renewable every year, right? Renewable every year, renewal of authority of this. So meaning that in the AGM, they say renew for another 1 year. Of course, it's not the industry practice standard to say renewal this authority to just issue private placement, do private placement for 10 years, which is why they have to say that the authority is only 1 year. Every year it renew. If a shareholder approve it, then for the next year, next 12 months, if there's any need to do private placement, they will do it because it already has been pre-approved. Okay, so this is what it means. And still, the other thing is about the renewal delay. So when they do private placement, there's a few things they say: future investment, buy new property, capital expenditure, or even to repay some of their borrowings. And the special business, they say ordinary business for AGM. Special business means that this is the agenda, which means the agenda also to pre-approve the upcoming investment dividend reinvestment plan for AXIS REIT. And you know that dividend reinvestment plan, they're going to issue a certain number of units out from the existing unit. So meaning that it's normally like 0.5 to 1%, less than 1%, but still this is a relatively small event, but still they need a pre-approval from all the shareholders during the AGM, which means that if they do that, then they no need to call for another extraordinary meeting, EGM, because calling AGM and all that, it incur costs. So for them, it's also very prudent, right? They have to say they want to get your pre-approval, which is fine. I think which is fine. Again, even if you're an investor, you don't participate in the IDRIP, it's fine. Investment dividend reinvestment plan, because the dilution is minimal, because the new shares issue is also normally like 0.5 to 1% or even lower. So I hope that actually covers this demonstration of how to read AXIS REIT annual report in a lot of detail. So I hope if you have any question, post below. If you are not a REIT method member yet, the course, you want to look at this below here, there's this screen, the text. Go to readmethod.com, sign for an upcoming webinar. So once you get the basics, then you can make sense of more of what I'm actually talking about here. But you're already a member, you don't need to sign for that webinar. You have probably listened to it before. So this video is actually part of the lesson. If you're watching that inside the portal, that's great. Any question, post below, I'm going to answer it. If you are not already a member, go for a webinar. And on top of that, if you like this lesson and you find this useful, click on like, click on subscribe. And subscribe to this channel, you can get more lessons like this in the future. You get notified. Now, if you have any question regarding the webinar or anything that I'm not covered, any queries, you can also post your comments below. Whether it's if you're a member, post below the comment section inside this module, or if you are watching this on a YouTube, so post in the comment section in the YouTube below, click like and all that, so you'll get notified. So that being said, click on my face anywhere, should be showing anywhere here to subscribe. And if you head on to another video lesson of mine, very useful. I'm not sure what are the lessons that are popping out over there as I'm doing this for you, but just head on the next lesson, related lesson over here, which is going to be very useful to you. I'm CF Lieu from REIT Method, and I'll see you in the next lesson. Okay, have a good day.